Are there downsides to doing it through a self-directed account that you might not have in a taxable?
Well, in a retirement account, one thing you got to look for is if there's debt involved.
Mhm.
And this is for IRAs, but any IRA or even HSA, this is traditional or Roth, when it's investing in real estate that's leveraged with debt, there's a tax on profits from the debt. And it's called UDFI, unrelated debt finance income tax. So when I said earlier, if I bought a property for 100 grand and I sold it for 150, if my retirement account bought the property with cash or I invested in a partnership, let's say an LLC with a bunch of other people and we didn't have debt on it, we sell it for 150, there's no tax on the gain. But if I brought debt into the deal, and let's say we just so I can do the math, I'm going to keep it at 100,000. I realize this may be a million or 10 million, but so let's just so I can do the math. Let's say it's $100,000 purchase, but you put in 40 grand from your IRA, or you and other partners and people in the deal, other investors essentially put in 40 grand to buy the property. And then you go get debt for the other 60,000. Let's say you then sell it for 150. There's a $50,000 gain and you get to write off any expenses, of course, that sell, but let's say it's a net $50,000 gain. The IRS looks at that and says 60% of this deal was debt. It was not retirement plan dollars. It was not capital invested. It was debt. And we're going to tax the debt that leveraged the IRA's purchasing power. So if their IRA put in 40 grand and got a loan for 60, they look at that as that 60,000 was not retirement account dollars. You don't get
Mhm.
tax-free treatment on profits from that. So on a $50,000 gain, you have to take into account the debt that you put into it, which was 60% of the deal. So 60% of that 50 grand would be subject to this UDFI tax. So that would be, I think, 30,000 in that
Mhm.
example. And then the UDFI tax on a sale of a property is the capital gains rate, 20%. 20% of 30 grand is six. So you'd end up, the IRA, I should say, not you, the IRA would end up paying 6 grand on it. So that's probably the biggest downside is
Mhm.
properties leveraged with debt that your IRA is investing. Now, despite that, we have plenty of clients that invest in leverage deals like that because the total return is better than the next best thing their retirement account can invest into. If they say, Matt, after that return I can get on the deal, even paying a little bit of tax, 20% capital gain, let's say, on only the piece that's debt leveraged, I'm still ahead of the crappy mutual fund I've been in. We want to look at the net return at the end of the day because the goal is to just get the biggest retirement account, the
Right.
largest
Right.
account at the end of the day. So you just kind of got to run the math, do the numbers, so to speak, on what you think your total return is going to be. And that's when I think someone should look at using their retirement account to do this. It's not, should I use personal dollars or retirement account dollars? A lot of times people's personal dollars are frankly more tied up
Mhm.
than their retirement account dollars. And they have a lot more leeway to use those retirement account dollars. So what I tell those clients is, and we're not financial advisors, but I just tell them just from a basics, what else is your retirement account invested in? What's it invested in now? Or what's your next best investment you would make? If this real estate deal is a better deal, even if it's leveraged with debt and you got to pay some UDFI tax from the IRA, are you ahead of the game? And if so,
Mhm.
then that's an investment you should consider.